It's good to have you. A lot of sort of conflicting opinions about what the market does tactically from here after last week's bounce. Some say this is a head fake. Others say there's been so much discounting done already that if you do have a 6-month, 12-month horizon, it's a smart move to start at least looking at selective sectors. Where's your head right now?
Yeah, so I think the way we kind of look at this is we are in, as best a situation as we could possibly be, and from the standpoint that the Fed is being very, very accommodative. They were accommodative prior to the virus becoming a huge health crisis, and they are remaining very accommodative and doing whatever it takes to make sure that this doesn't spill over into a very nasty economic recession or worse. And then the other thing that we would look at is the fact that when you compare like some of these other major corrections that we've had in the past 20 years, call it, in 2000, 2001, the economy was already showing signs of weakening. The Fed had been raising rates a little bit, and the economy was weakening. And then when September 11th happened, that was sort of the catalyst that really took the market into super bear market territory. When we saw 2007, 2008, same thing. There were lots of signs of stress going on. The Fed had been raising rates prior. And in this particular situation, we don't have those conditions. So we think that argues for once things get back to normal, once we have potentially a virus treatment or, just more testing and the social distancing actually is working and we can return to normal lives, we think that you could see a decent recovery. It's just going to take a couple of quarters before it can really manifest because I sort of described Oh, yeah, sorry.
Is it fair to say then that the speed of the policy response and the relative health of the economy going into this with a so-called head of steam, that's what makes this different from past crises or even '08?
I think so. I think that that's true. And so to the extent that we can keep the liquidity flowing to our companies and to people, we may be able to skirt the worst-case scenario, which is, devolving into a credit crisis. And if we can avoid that, I think there's a case to be made that within a couple of quarters we can begin to ramp back up.
So, Sandy, just to dig into that a little bit more, I mean, you've got J.P. Morgan saying the market rout is probably past its worst now. You've got Mohamed El-Arian, who's been exceedingly cautious, to say the least, for weeks now, on our air this morning saying we're not in an all clear for stock index buying, but the sell everything moment has passed. I realize from an economic standpoint, the worst numbers are still yet to come. But from a market standpoint, is it safe to say that we could be actually near a bottom? How do you see it?
Yeah, I think that will depend on the commentary from companies. And I think when they have their earnings reported in April, is just going to be a lot of uncertainty. But I think when the data begins to actually turn and we can start building a pathway towards a resumption of economic growth or even just a not worsening situation, that will set the stage for when companies or when investors can begin to look through these massive moves that we've seen and their worst case fears allayed, and then begin looking at companies that are pretty beaten down now. There are a lot of stocks that are very beaten down. Valuations look attractive. Dividend yields, because we run an equity income fund, we are focused on companies that have high quality balance sheets that are paying dividends where we think those dividends can be sustained over a short, medium, and longer period of time.
And Sandy, a lot of investors out there have a timeline that's far longer even than 6 months or a year. A lot of people investing for retirement looking at least 5 years or longer. For the people in that category, what are the assumptions that they should have about this market and whether they should be either just buying now with spare cash or even shifting their portfolio allocations into more equities given what the market has been doing?
Well, I think this is an asset allocation decision which should be done in consultation with whoever their advisor is, because everyone's personal situation is quite different. But I would just say that I think right now there are a lot of high-quality companies with very strong balance sheets and very, very good defensible businesses that are paying dividend yields that are, well above the market, so to speak, and where we think those dividends can not only be sustained but can grow over time. And to us, that's a very, very good investment combination.
Hey, finally, Sandy, and not to get too wonky, but sort of the VIX futures are interesting. Our Bob Pisani has a good piece on our website this morning where you look at April expecting the VIX to be 55, 45 in May, 40 in June, 30s by August. How much credence and faith do you put into that kind of hope that volatility will be suppressed as we move forward?
I suspect as we begin to see improving data, and particularly as we begin to see, sort of treatments and testing and even a vaccine that may come out sometime in the future, those are all going to be issues that begin to allay the worst fears, and I think that will bring the VIX down. The very fact that our credit system remains intact and we don't tip over to some sort of credit crisis, I think that helps the VIX in the sense that it brings volatility down. And then I think people will begin focusing on what these companies are, what their earning power is, how strong their position is, and realize that there's some great values out there.